Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity. Thank you, and I look forward to your questions.
This guy sucks. Jerome, I think we both know what has to happen, but are you willing to do so?
No, I don't think so.
So interest rates won't go down again?
The ultimate level of interest rates will be higher.
Okay, but how much higher will they go?
We still have some ways to go.
Jerome, look what you're doing. You're killing the economy. Inflation for October was much lower than expected.
Yeah, so it will become appropriate to slow the pace of increases.
So now you're saying you are going to pivot?
Sorry, was I getting to your question?
No, not at all. Meta recently announced that they are going to lay off 11,000 employees. Is this a trend that you would like to continue?
Of course, that's what we'd all love to see.
Okay, but that would mean that my Meta stock would go to zero and you would just not give a fuck.
I don't have a specific number for you there. There are many, many models.
Okay. All jokes aside, you are going to print more money, right?
That's what we really need to do and what we're strongly committed to doing.
So guys, it looks like the Federal Reserve is going to pivot. It was a tough nut to crack, but hey, in the end I came through and we did it. Okay, but in all seriousness, today we're going to analyze whether the Federal Reserve is going to lower interest rates and when that might happen. And before I give my own opinion, first we're going to look at what the market is thinking and what the market is expecting, and then I'm going to give my own analysis. So, are you ready? Let's go. So before we look at what the market is thinking, let's first discuss what this Fed pivot that everyone is talking about, what it really means. So the Fed pivot simply means that the federal funds rate will go down again. So what is the federal funds rate? The federal funds rate is simply the target rate that is set by the FOMC. And it is the rate at which commercial banks borrow and lend their excess reserves with each other overnight. And they have to do this because they have to meet their reserve requirements. Now let's say we have one commercial bank and another. And the one commercial bank has too much reserves. It has excess reserves. But the other bank has too little reserves. So what they can do is that one bank with excess reserves can lend the money to the other bank at the federal funds rate. And because of this, everyone has met their reserve requirements and yeah, everything is fine. So now that we know this, let's go into this chart and show you what the market is expecting. Okay, so over here I'm at the Federal Reserve Bank of Atlanta site and I have the market probability tracker. Now this market probability tracker basically predicts what the market is thinking about where the interest rate or the federal funds rate is going to go. In this case, it is based on the 3-month euro-dollar futures, and these are a very good substitute for actual federal funds rate futures. So, but we will look at that in a minute as well. So let's go to this chart here. We can see the expected future path of the 3-month average Fed funds rate. And as we can see, the market expects rates to peak at around 5% in March or in June of 2023. Now, as we can see here, the probability of a rate hike or cut is very high. And this basically remains very high up until September of 2023. Here we still see that the market is predicting a rate hike of 80% by September of 2023. So I personally don't think that is going to happen. And also I will go to this chart, which shows the 30-day federal funds futures quotes. And how you interpret this is basically you subtract this last number, so that the last price, the last quote, you subtract that from 100. So in this case for November it would be 100 minus 96.2, and that would be 3.8%. Then for December it is 4.2%, around 4.2%. And then again it will peak over here in May and June of 2023, it will peak of around 4.9%. So let's say 5%. So again, the federal funds futures quotes are again predicting that the federal funds rate is going to peak at 5%. But again, the market here is predicting that the federal funds rate is going to peak in May or June. I personally believe that it's going to happen in March of 2023. So now that we know what the market is thinking, what sort of analysis can we make ourselves? And I think to begin with, it is good to first look at what other central banks are doing. Because it is very rare, it never really occurs that central banks don't follow each other's footsteps. But what you can see in the graph is that all central banks have massively increased interest rates, but that's not really that important. What is more important is look at the slope. Look at the slope of, in this case, the Reserve Bank of Australia and also the Bank of Canada and the Norwegian bank, so the Norwegian bank. When you look at the slope, you see actually that the slope is decreasing, and this has also been in the news. The Bank of Canada, Reserve Bank of Australia and the Norwegian bank have all lowered interest rates with a slower pace. And that is important. That is very important. Because the Federal Reserve and the ECB, they are not doing that yet. But as we all know, banks follow each other's footsteps. So that might be the first sign that the Federal Reserve and the ECB are also going to slow their pace of interest, of raising interest rates. But of course, this cannot be our only source. We have to also look at what other people are thinking. Fortunately, other people are indeed thinking it as well. So, for example, Goldman Sachs, as of recently, also said that they expect the Federal Reserve to raise only by 0.5% in December. You have multiple Fed presidents, also as of recently, and definitely after the latest inflation reading of 7.7% year over year. You also have a lot of Fed presidents now saying that, they think it is probably a good decision to only raise by 50 basis points or 0.5%. So before I explain what the Federal Reserve is likely to do in the meantime before raising interest rates, let me give you a nice overview of monetary policy. So let me give you an outlook of what's going to happen. So in stage 1, and we have already passed that, and again, I'm looking at my laptop over here. In stage 1, that is called when are rates going up? That started in 2021 and that ended in the beginning of 2022. I mean, we know that interest rates are going up right now. So currently we are in stage 2. Stage 2 is interest rates are going up, but till what level? I think at the moment we're pretty confident where they're going to end, but a few months ago we definitely were not. So we're at the end of this stage. And that means that this stage runs from March of 2022 until the end of 2022. Now, stage 3, and we're close to that, is that interest rate hikes are slowing down. So again, this is from December of 2022, right, the 50 basis points, until March of 2023. Now, stage 4 is interest rates stay where they are. And personally, I believe that that will be from March of 2023 until the end of 2023. And finally, when is the Federal Reserve going to pivot? And that is stage 5, so interest rates going down. That is somewhere in 2024. And I know what most people are thinking right now. This is not true at all. And they're going to pivot much earlier because the economy is going into a recession and unemployment is going to skyrocket, etc., etc. Now, okay, before we go into that, again, remember, monetary policy is mostly based on psychology, on psychological beliefs. Now, most of the times these beliefs are not really true because, I mean, most people just look at CNBC in the morning and see, oh, the Federal Reserve has lowered interest rates. That means inflation has to go up. Or the Federal Reserve is raising interest rates right now. That means inflation is going to 2% again. Right? Most people are thinking about it like this. And, you know, that's okay, but it's not true. Okay, it's just a false belief. And they are not going to lower rates when inflation is still at 8%. I mean, inflation is slowing down a bit. It's come down to 7.7% year over year, but it's still way too high. And with these high rates of, let's say, 5% federal funds rate, it is simply waiting for either the economy to fall apart or that something is going to break in the financial system. And I think the second is more likely, given that we've already given what we've already been experiencing in the last couple of months, for example, with the Bank of England. And the Federal Reserve really does not care about your Meta stock. It really does not care about your Apple stock or your Tesla stock. Trust me, if your stock portfolio crashes with 8%, they don't care. I mean, maybe that's even what they want. I mean, maybe that's, right, this reverse wealth effect. You can look the wealth effect, if you don't know what it is, you can look it up. But maybe they're even trying to create this. They want this reverse wealth effect so that inflation and spending also comes down. So that is a possibility. But getting back to my point there, I think that they don't care about your stocks. I think they care about the functioning of markets. I think they care about financial stability and simply the sort of the economy surviving while it still can. Now, when that changes, so I think this will happen in 2024, when the economy really starts crashing down and unemployment spikes, that is the point when I think they're going to pivot. That is the point when I think they're going to lower interest rates again. And again, of course, this prediction could be wrong if something happens in the meantime. Maybe something really unexpected, like a black swan event happens. And, you know, nobody can predict that. I don't have a crystal ball. So these are all predictions, and as usual, predictions can be wrong. I do believe, however, that something is going to break in the financial system, in the financial markets, maybe in the corporate bond market, maybe in the treasury market. Something is going to happen in the meantime, so between now and the moment the Federal Reserve is going to pivot. And look, for example, what is going on right now in the UK with the Bank of England having to bail out all these pension funds. So I don't think rates are going to go lower. I do think, however, that they are going to use a lot of monetary policy tools to sort of glue the monetary system together. Okay, and one tool they have is a treasury buyback program. And as of recently, also with Janet Yellen, it has been a lot in the news that the treasury is going to do this. And some people expect it to happen in 2023. And this all has to do with liquidity issues. And in this graph, again, this graph over here, you can see that liquidity in the treasury market is extremely bad. It's not good. And the treasury now has to intervene because, a liquidity issue, liquidity crunch, so to speak, is going on right now. And the solution, and there could be quite a smart solution for this, is that the treasury is going to issue a lot of new underrun bills. Okay, so it's going to issue underrun bills, and with the revenue that it generates from that, so essentially it's borrowing the money, right? But with the revenue that it generates from that, it's going to buy these illiquid after-run treasuries from the market. And that means that there are more treasuries in general, but the market is way more liquid and the collateral is much better. And that will improve the financial conditions. Now, this is quite difficult and maybe you don't even care about this. So why is it even important to mention? Well, because this buyback program shows that the Federal Reserve has all these monetary policy tools it can use before switching to lowering interest rates and doing QE again. And I would even argue that lowering interest rates and QE is probably the last thing they want to do. It's probably all the way on the bottom of their list. And the last thing, which is really important, is mortgage rates. We know that mortgage rates are heavily influenced by interest rates. So if interest rates go up to, let's say, 5% in the US, mortgage rates on a 30-year fixed could go up to 10%. And I would argue that that might not even be that much of a problem for the US. However, for a country like the UK, where I think the average fixed mortgage rate has a maturity of like 3 years compared to, 20 years in the US, that is a big problem. That is a big problem. And another big problem, what they have in the UK, is that there are a lot more variable rate mortgages compared to, let's say, the US. And that means that, let's say, interest rates go up in the UK or in Europe, that it will have a much more direct impact on the economy compared to, let's say, the US. So if something breaks on an economic scale, so in an economic perspective, then it will likely happen outside of the US. But I want to make clear that this is my prediction for the short run. I'm not talking about the long run, because in the long run, I expect the dollar to virtually go to zero. I mean, every currency will eventually go to zero, but the dollar will go to zero as well. And this decade, so the decade running from the 2020 to 2030, I think this will be a very inflationary decade. We will have very high inflation. We will have price controls. We will have stuff like yield curve control. Again, interest rates will go down again. Quantitative easing will probably start again. And it will just not be a good time for the dollar, especially when you look at the national debt, when you look at the trade deficit, the budget deficit, how much the government is spending right now and how much they're going to spend even more when we're going into a recession. It's not looking good. And if interest rates go lower again and inflation goes up, then the dollar will go lower and eventually, like all currencies, will go to zero. But this is the end of the video. Let me know what you think about if interest rates are going to fall or maybe they're going to keep rising. Feel free to like or subscribe or share this video if you want, and I will see you the next time. Bye bye.